Joining us now with his outlook for Treasury stocks and other assets is Michael Cuggino. He's president of Pacific Heights Asset Management. Morningstar ranks the permanent portfolio fund that he manages the best performing balanced fund for the past 5 years. Michael, good to have you back here with Matt and myself. I'm going to jump right to Treasuries at this point. I mean, outperforming, doing so well. At this point, if you haven't gotten in Treasuries, is it too late in your view?
I'm not so sure. Clearly, they've run up quite a bit, but I tend to think we're going to be in a longer-term trading range here, which we've actually been in for the last couple of years, based on current Fed policy and comments that they've made in various forums lately relating to interest rate policy, monetary policy, and further stimulus. So I think we're going to remain in a trading range, and so investors need to keep that in mind, maybe selling when yields get real low and then buying back when yields cool off a little bit.
How much, Michael, has that run up? I mean, Carol mentioned 28%. It's pretty unbelievable for Treasuries. How much has that had to do with Fed buying? And if a lot, then how does this twist change that? I mean, can you go into the longer end of the curve now and expect the same thing to come from 30 years?
Well, absent other factors, I mean, the twist is really neutral because you're selling the short stuff and buying the longer stuff. What it's going to do is flatten the yield curve on the longer end in the hopes that that may stimulate lending. I'm not quite so sure. I think it's much to do about nothing, to be honest.
Yeah, but Michael, if the Fed's doing that,
more on a fiscal side of things versus monetary policy. However, it should drag longer rates down. Theoretically, that would help borrowing. We'll see what happens. I couldn't tell you at this point.
Could you get ahead of the trade? I mean, if the Fed's going to sell the 10s and buy the 30s, do you do the same thing?
Well, I think you probably would have done that. And in fact, longer-term rates did come down before the Fed's announcement based on the speculation that the twist, operation was going to occur. So I think you already saw that happen. And a good chunk of the Treasury's gains in the last few months have come in probably the last month or so during the lead up to this announcement and then the actual announcement itself.
Hey, Mike, how important is it in terms of what happens to the economy, whether or not we go into a double dip recession, in terms of performance, future performance for Treasuries? I mean, if we go into a double dip, does it make sense to continue to keep buying into Treasuries maybe all along the yield curve?
Well, depending on the severity of the downturn, double dip, whatever you want to call it, I mean, that would tend to probably flatten rates across the board, which means that you could have further gains to be had in Treasuries. I think investors in Treasuries right now have to be very careful. I think there will be money to be made on the trading side with respect to playing the yield curve, although you can't argue with the overall valuations right now with Treasuries, and they are historically high, and the likelihood is that they're going to go down at some point more than they're going to go up, and in terms of value. So, I mean, investors have to be cognizant of that.
Before we move on,
you're not getting really rewarded for the risk you're taking on in Treasuries right now.
What's the buy that you're making in Treasuries right now? I think you've got, what, about 35% Treasuries and high-grade corporates?
That's right. I mean, corporate spreads are better than Treasury spreads, obviously. You don't have that guarantee.
Right.
But I think what we're trying to do is find the spot, the sweet spot between yield and risk on the Treasury curve, while also maintaining flexibility. I mean, our durations have come down in anticipation of, potentially rising rates at some point and maintaining flexibility. Although we also believe that a properly diversified investor, to guard against deflation, double dip recessions, or other asset devaluations, needs exposure to Treasury. So we're trying to marry up the shorter term trading implications with our longer term overall, macro strategy.
Hey, listen, I do want to point out we've got equities at their highs of the session. I mean, we've got a pretty decent rally underway. You are also, because you're a balanced fund, you've got about 30% in equities. Mike, what's your take on equities right now? Where's the exposure you want to have?
Well, interestingly enough, Treasury yields have come down, have gone back up a little bit today. Theoretically, maybe you have some money moving out of Treasuries and back into equities. It's a tough week because you have end of third quarter.
Right.
You had a lot of activity last week, a lot of market activity. You've got Q3 earnings coming up. So we tend to think risk-reward. I was mentioning the risk-reward's not that good in bonds and Treasuries, but it's a lot better in stocks. I mean, the market's trading at reasonable multiples based on earnings. There's a lot of liquidity on the sidelines. Dividend yields are very favorable with a lot of companies, and in most cases exceeding comparable bond yields. So you can be paid to collect your dividend as long as it's supported by earnings and wait for the growth story to emerge. And if more liquidity comes into the market, you may see multiple expansions. So a lot more potential growth for equities, but you're going to have to stomach the risk and wait a little bit.
Michael, you know, we were talking about window dressing earlier as we come to a close for the quarter. I want to know what's your take on that. And also, we had the biggest drop in gold last week that we've had in any week since 1983 because apparently a lot of fund managers selling it to raise cash. Are you in on either one of those trades?
I can't discuss specific trades, although I will tell you that our views on gold have not changed. We think given the negative real interest rate environment, given the demand, given the uncertainties and negatives on fiscal policy, the issues in Europe, and until that macro environment of loose money and uncertainty changes, we think this is sort of a shakeout of hot money, and it's probably going to send gold prices, you know, higher highs and higher lows over the long term. However, you also got to remember that you had a fantastic run up for the last few months, and assets like gold correct. They're volatile, and as an investor, you need to stomach that. So if you weren't in it, it may be a good buying opportunity in the long term if you believe in some of the factors I mentioned. If not, you ride it, maybe, you know, speculatively add to your positions.
Got it. Hey, Michael, thanks so much for joining us. Appreciate it. Michael Cuggino there,
Thanks,
president
guys.
of Pacific Heights Asset Management.